production, farming, real estate. This is January 23rd. Again, all this is up on the calendar. Speaking of the calendar, everyone should have received an email this morning with the calendar for the whole year. The only date we do not have in is August, and we'll talk about that in a little bit depending on what we want to do. There's a few things that have come to our table in August. We try to do some fun. We will be again at the top of Arizona Iced Tea for the rooftop for our summer celebration in July. But if anybody doesn't get it or hasn't gotten an email or can't figure out how to download it, I do have some copies of the calendar for the whole year. We are having the educational series is two of them have already booked up that we're going to do. The first one's going to be 101 sales, and there's actually a different title which I'll send around. And we are looking to do in April, almost like a speed dating type of producers to distributors or users or something, just to get some action going, kind of a follow-up to the Sales 101 for everybody. So we are looking for help, or anybody that's interested in helping us put this together to get the companies more adjusted to selling, and some of the newer companies on presentations and rooms like this, and to whoever they have to present to. We are scheduled for a couple of special events. Some of them may be limited in their access only because of the size. We have one coming up, White Coffee, I'm not exactly sure the date, but I'm sure it's on the calendar. It's going to be a limited first come, first serve. We are reserving some spots this year for sponsorship, so will put a quick plug in. It is the beginning of the year, so we are looking for sponsorships. There's information on that. It will go out to everybody as well. We do have a tour, I think another one he's not here, Kevin, because I think Patchogue Brewery asked us if we wanted to take a tour of it, so I'm sure everybody's in for that one. And there's a couple other places, so if you find places we can go and take tours of, just let me know. We can add it to the list, and then we can work through some of that. ESD sent me something on a trade mission to South Africa. Now these trade missions, especially for the producers, there is money and grants available that could pay for almost all of it. You'd have to talk to ESD about it, but they are now have a new one June 1st going to Johannesburg and Cape Town, South Africa. And again, grants are available to help pay for the cost of doing it, and I have information on these as well. I will jump back in, but I guess we'll get started. TD, thank you very much for hosting, and also our first sponsor of the year. They are sponsoring the Food Council this year. Thank you very much. I appreciate it.
Absolutely. Welcome. I'm Kim Keller. I do relationship management for a TD Bank, meaning small business lending, bank accounts, payroll, etc. Bring the whole bank to the small business. And this is Elena Malahi, and she does our SBA Lending. So there's obviously different ways you can borrow depending on the stage of your business. So we just put these up here, obviously borrowing from yourself, borrowing from others, conventional bank loans, SBA guaranteed loans, alternative lenders, nonprofit, community development, financial institutions, and grants, which I know we've had some speakers about the grants. Elena and I are going to focus on the bank lending and the SBA lending. So just a very high overview. What I do is either lines of credit for your operating capital, term loans, so if you have equipment purchases that you need, if you have some kind of capital that you need to raise for any type of fixed asset. If you're looking to purchase a building, commercial mortgage, we offer. And then we also do offer, which is a very specialized program for small businesses under $150,000. We even allow like cash business, food service industries for up to $50,000. It's just a small line of credit to help your business. So it's just a very limited program that we offer with, very small financials, easy application, easy process. So that's like traditional lending that we do. We also do leases. That's pretty much it for the small business. Of course, the bank account, we partner with a payroll company that offers full HR, payroll, the mobile apps, etc. for that. Merchant services, if you're accepting credit cards, we have very competitive rates and prices for merchant services. And then any other service that your business would need in the financial arena. And Elena does our SBA lending, and she's going to go into more detail, and we left you some flyers for our SBA lending.
Terrific. So Where the SBA comes into play for the bank, a lot of times loan requests will come in and people aren't asking for SBA. They might not know what it is, they don't know if they meet the criteria. So a lot of the loan applications that wind up coming into the bank, you know, someone on Kim's side would look at an application and make a determination that there would be some benefit to the client of looking at a deal through the SBA, then I'm brought in and look at that. So some of the typical situations would be, you know, younger stage companies, where they might not have the long track record that conventional lending would be looking for, companies that would benefit from a much lower down payment. So if we're looking at a transaction to, you know, do a business acquisition, buy a piece of real estate, the minimum down payment that we would need on the SBA side is as little as 10%, where on conventional you could be 20 or 25 depending on the project. So it's a way to keep money in people's pocket, especially on the real estate transactions, for someone to be able to get into a property with as little as 10% down. And on those deals, we can go out 25 years on fully amortizing, no balloon, and give somebody the lowest payment, you know, monthly payment possible. So a loan could come in for someone, you know, conventionally, and if they need to put 20% down, and if it's only gonna be amortized, you know, might have a 10-year balloon, a shorter amortization, the numbers might not work. The cash flow isn't there, they might not have the down payment, and somebody walks away and says, well, I can't get a loan. I would love to control my fate and buy this building, expand, buy new equipment, but I don't meet the criteria. What we try to do is then look at the SBA as another alternative and say, okay, if you could put 10% down, if we could stretch your payments over 25 years and add some of the other benefits, do the numbers work now? And in many cases they do. So that's something that we do quite frequently. The key for us is looking at what programs does the client fit into. Some of our borrowers, you know, could work with a conventional loan, and we have two other loans that are summarized on that sheet, a 7A and a 504. Some borrowers would really be eligible for all three of those. What we try to do is give the borrower the most options available. So if you're looking at, you know, buying a building, acquiring a company, buying equipment, doing an expansion, any of those things, you might not be thinking of an SBA loan up front, but that might be something we would propose to you. So it's a good way to get a loan done. So that's really how we approach those deals. The government provides an enhancement to the bank. They'll guarantee a portion of the loan on the 7A, and it allows the bank to be much more flexible in our lending terms and get a deal done that we wouldn't be able to do normally. So we'd like people to, you know that there are some more flexible options out there than just what they may be thinking of in terms of a conventional loan, and might give them the ability to make a transaction that they wouldn't think they could otherwise do. So it really gives a lot more flexibility and more options. So I don't know if anyone in the room, I know we've got, you know, a lot of experience in this room, if anyone has gone through, you know, the steps of applying for a loan and maybe had, you know, surprises or things that they could share that we could shed some light on. I would say the biggest thing that we come across for newer companies is, you know, personal credit being a big issue. You know, you have a lot of people who, when they're starting something up, they're exhausting everything personally. They put everything they have into it and they think they're doing the right thing, and then sometimes their personal obligations will suffer, and then by the time they go to the bank for a loan, their personal credit is not in good shape and really could preclude them. So, you know, one of the things that I, you know, like to get to people early before they make those mistakes is, you might, you know, some people think they're doing the right thing by trying to do it all on their own. Sometimes by bringing a bank in earlier and, you know, leveraging yourself and putting a deal on the table in front of the bank where maybe you could get the financing that would be more appropriate to help grow your company, you would put yourself in a better position. It's not always better to try to do it on your own, because sometimes you really do put yourself in a hole then, and then by the time you try to get a bank involved, it's really hard for anybody to do anything with someone who still has that newer company that isn't, you know, necessarily, you know, proven itself or doesn't have a long track record, and now you have a borrower that has substandard credit, and that's a huge part, you know, of lending in general. But when we do the SBA loans, it's a really, the character and the, you know, personal handling of the debt obligations is a huge factor that we look at. So, you know, that's one bit of advice that I would give anyone as they're, you know, thinking about financing or expanding and doing a project.
Does anybody have any questions for Alina or for myself?
I got a success story.
Oh, great.
I had a tenant who was in 3,000 square feet, and he was exploding in growth in sales, so he wanted to go out and buy a 5,000 square foot building, and he asked us to go out and find it for him. He had 25% to put down under what the market rate was. However, since he was exploding in growth, we were able to get him into a 10,000 square foot building he was able to acquire. There was a 5,000 square foot tenant in place, but if he had 25% to put down on a 5,000 square foot building, less dollars, fewer dollars he could put down on a 10,000 square foot building by taking him through SBA.
Perfect.
And now he's covered for growth for the next 10 years for sure.
Right. Yeah, the key on the SBA loans with the real estate is that they're 51% owner occupied. So, you know, the SBA does allow for some investor portion of the property, which is great when somebody wants to move once. You know, you have a company who might be busting at the seams, they can only afford, you know, maybe that 5,000 square foot building, but they know in another year or two they're gonna be in the same situation and they will have outgrown that building. So to have the ability, even though you may have the money, the down payment, will the numbers work for a loan for that 5,000 square foot building, you know, as Paul's saying, you know, being able to leverage that SBA with that lesser down payment, stretch the, you know, the payments out over 25 years, and there's no balloon on that. So when someone goes into one of those SBA loans, you know, you can get a fixed rate for 25 years on that, no balloon, it's fully amortizing. You put your 10% down, and you know, if you want that loan for 25 years, it's there. You have no risk with your, you know, knowing what your payment is, where rates are. You know, we fix them for the entire term of the loan in most cases. So it really is a great product. Versus on the conventional, normally you'd have a 10-year balloon. So people get concerned if they've been through, you know, one of the swings in the economy, and, you know, in year 9 isn't your company's best year, and the next year your loan's ballooning, that loan might not be renewed and you're out on the street. You know, now you've got a ballooning loan, and that doesn't sit well with a lot of people who've been through, you know, the swings in the economy. So having that there for 25 years is fantastic, and then it only has a 3-year prepayment penalty. So if a customer wants to get out of it, they have the ultimate flexibility. You know, we almost look at it in some cases like almost like, you know, bridge. It's bridging you. You can get into something that you wouldn't otherwise be able to afford, but you can also get out of it.
Please speak to not only the acquisition of the real estate, but also the improvements that you're going to make in that real estate.
Absolutely. So that's one of the other things with the SBA loans. You know, it covers so many different use of proceeds. It's not unusual that we would have one SBA loan that would be for the purchase of a building, renovations, equipment, sometimes even refinancing some existing debt, or maybe lines of credit that have become permanent that really aren't revolving anymore, and we'll throw that in. Sometimes some working capital, closing costs. You could have 5-6 different uses in one SBA loan, but if that loan's for real estate, it gets the 25-year term. So they can, you know, we do see that a lot with, especially, you know, a lot of the companies that took out lines of credit, and as the companies are growing, the lines don't revolve anymore. It really becomes a permanent working capital base. It's almost like a bad credit card at that point. You know, the line doesn't move, there's no availability, and they're paying interest only every month, and it just doesn't go away. And that's not what a line of credit is for. You know, a line of credit should be short term, it goes up and down, you pay interest on what you use, and you have availability when you need it. But, you know, more times than not, you see those lines get maxed out and just sit there. And that's something that we always look at on all the deals is, what does the existing balance sheet look like? How much debt does the company have? Sometimes it's equipment leases, and the payments on those things can be crazy, you know, and we could have equipment with, you know, 15 to 20-year useful life, and the payments on it are astronomical, and while, you know, we might not be thinking about refinancing it, when we look at the balance sheet, we're looking at lines that are, you know, maxed out, what other debt they have, and a lot of times it's those equipment leases, and can we refinance those within the project as well? And a lot of times, you know, the cash flow savings, when we start restructuring other debt on the balance sheet, we look at what somebody was paying for their existing debt. They could be buying a building or doing a major acquisition, refinancing all of that, and have an incremental increase in their monthly payment because of restructuring. So, you know, it's always good, you know, get some people who are overly optimistic who, you know, have, you know, lost money every year, and they come in and they want a, you know, $10 million loan, and then you get, more times than not though, I see people who are, you know, just assuming that they won't qualify for something, or they just think they can't get it done. And sometimes just having that dialogue you know, with a lender or someone you trust for some advice to say, I'm thinking about doing this, is this feasible, or how could it be feasible? How would I need to position my company, you know, if in the next 5 years I wanna be able to buy a building, or I wanna be able to, you know, expand or buy new equipment, what would I need to start doing today? And a lot of times that's missing in the conversation, and that's something that's really important. People want something and they hadn't put any thought into it maybe up until that point to do the planning. They're just thinking, you know, I might wanna do this, and missing the step of what do I need to do today to start planning for it. And if you don't position your company the right way and set yourself up the right way, you know, when the time comes and you wanna make a move, you might not be in that position. You know, we even see it a lot with, you know, conversations with your accountant. Yes?
Can you say a little bit more, because you're talking about preparing for even approaching a bank, say a little bit more about the connection between your personal credit and what happens as a small business owner?
Yeah, it's huge, and I mentioned, you know, that's one of the mistakes, if you wanna put it that way, that I see a lot of people make, is really well-intending people who sacrifice, you know, in their minds, they're sacrificing their personal credit because they believe in their business and something they're doing, and not realizing that by not keeping your personal credit affairs in order, you are negatively impacting your business and the ability to borrow. So personal credit is huge for us.
Is there a minimum FICO score?
There is no set number, but I have to say most of what we do are 680 and above, and most are really in the 700s. I'm always cautious to like say a score because we don't do credit scoring, and when you look at a report, I certainly have seen, you know, could put 2 credit reports side by side, and the one with the higher score, I would be less inclined to lend to that person than the other one, because, you know, sometimes the things that bring a score down are, you know, a cell phone dispute, sometimes it's, you know, medical bill related, you know, when you see that on there, those are things that could bring a score down. But, you know, if we understand a story, someone was sick and they're disputing with an insurance company, and you see it's medical, to me that's very different than someone who didn't pay their mortgage or had their car repossessed. And sometimes those scores are out of whack and they don't always make sense. But I will say, you know, 680 is, you know, you're probably not gonna see too much getting done with a score lower than that in most cases, and most of them are in the 700s. Really what we're looking for are, you know, you want people who pay their bills. You know, you want people who have a good track record. If they've been late on anything, you know, when was it, what happened, you know, were they 30 days on a credit card once 5 years ago because of, you know, auto debit didn't go out, or they, you know, bill got lost, that's excusable. But when you see a pattern and you see people who have lates on multiple things repeatedly, you know, those are indicators that that person is either, number one, just doesn't take their credit seriously, or someone who maybe is very well intending and just isn't organized enough. And it's like, if you can't keep your own house in order, so to speak, how can we trust that you could run your business and keep your business house in order? And that's really what it comes down to. Like, you've gotta look at your personal credit, like, you know, when we're looking at these loans, people always wanna separate themselves from the business. It's all one and the same to us. You know, you are your business. So how you conduct yourself in your credit is how we will assume you're conducting, you know, and running your own business. So it's extremely important, and I can't tell you how many times we will see deals come in and the borrower will wanna throw more collateral at us. You know, the credit score is bad, but what if my father puts a house up? You can put all the collateral you want on the table. If we're not comfortable with the character of the person and we don't feel like they're going to repay the loan, we don't want you know, that's just a deal that we don't wanna do. We're not in business to say, okay, well, we don't know that they're gonna pay, we don't feel really comfortable, but that's okay because we'll go take their house and we'll foreclose on. No banker wants to do that. You know, people think that sometimes, that, you know, well, they take all this collateral and they don't care because they'll just, you know, they'll get paid anyway. That is, nobody goes into a loan wanting to do that. That's a last resort. So if the credit isn't in order and you can't get comfortable with someone's character and how they handle themselves, that's a deal that most bankers will walk away from, regardless of what the cash flow looks like and what the collateral looks like. Conversely, on an SBA loan, if someone comes in and, you know, they're building up a company, they have good trends, their personal credit is good, they've put some money into the deal, you know, into their company already, they show a commitment and an investment, and we like this deal, and one of the flaws may be there's no collateral. You know, it may be a UCC filing on business assets, which really is, you know, nothing in terms of a real liquidation value. Maybe they have a house, but if they do, it has nominal equity in it, and you could have a collateral airball. but we like everything else, that's when SBA can come in and help. You know, you don't have to, we like collateral on the deals, everybody wants a deal with collateral, but if there's a shortfall and everything else on the deal is really strong, that's where an SBA guarantee can really come in. But if you look at it the other way and you have all the collateral and everything else is great and your personal credit shows you're a mess, no one's doing that deal, not for any rate that you would want. Yes?
Are your deals usually, do you have projections from businesses?
In many deals. Yeah, if we have a company that's, stabilized and they're buying a building and, we've got 3 years of tax returns and it shows that they could afford that building, in at least the last couple of fiscal years, and there's no expansion going on, projections aren't necessary. On deals where, they're buying a bigger building, new equipment, they're doing some expansion, that's when projections would come into play. And, you can on an SBA loan, some of those deals will get made based on projected cash flow. But what we won't do is, a company is losing money every year and they have no positive cash flow and they're moving into a bigger building, doesn't necessarily mean that, we start multiplying earnings and we just assume they're gonna be profitable. So, you will get projections sometimes that for really no apparent reason, all of a sudden miraculously, the numbers are going to look like this. That's not going to be well received. What we're looking for if we're relying on projections is a company that is growing, is showing positive trends. They may be kind of, strapped because they have maxed out on their space, they can't expand, and they're kind of just stuck where they are. And we can understand that by moving to a larger building or buying another piece of equipment, how that would positively impact the company and their cash flow. That's where projections come in, that show here, if we do this project, this is what we expect to happen and this is why. Not just we did a spreadsheet and assumed we're gonna do 20% better than last year and our margins will improve miraculously. When you get deals like that, they will not be well received. But we, done plenty of deals in SBA where historical cash flow doesn't show enough to fully, cover the required debt service for the loan they're asking, but it's close and we can see why it would make sense in the future. That's a deal that would work under SBA, so it's definitely an option. It's the pie in the sky, as we like to call it, just crazy numbers with no explanation, no basis for it.
A lot of the times that's where people think they don't qualify, so they don't realize that if they show those projections
Right.
correctly to the bank and efficiently and with work in it, then we can get it done for you.
Exactly, and when people take the time, I always feel like with loan applications that, you talk to a prospective client, we discuss a project, you understand it, you say, yeah, this sounds like something we might wanna do, here's how we could get it done, but here's what I will need from you. I'll send you a follow-up with an email, here's 10 things that I need you to get me, tax returns, your personal information, and you just don't hear back from them. Or like 2 months later, they come back and give you one thing, and it's like, sometimes you feel like, okay, people, we're willing to give you some money prospectively, you'd think you would have people's attention, or that they would be willing to spend the time. And that's what is concerning sometimes when people are saying one thing, they're saying they wanna do all these things, and you have a potential path to help them, but they're not even willing to take the time to work on a projection or put some thought into it. And you'll get an application that's just a sloppy mess, there's no detail, you're asking for background and they write 3 words, describe your business. I'm a 25-seat restaurant, and then when you ask them, well, you know what a restaurant does. Well, I do, but I would like a little more, so, that's something that, if you're, looking for something from anyone, you should show that you're committed and you're willing to spend the time, and you need to think of it really when you're going into that is, you're giving them the information to help get something done that you want. So whatever information that you would want to be conveyed to people making a credit decision, the frontline people that you deal with, if I speak to you, I don't automatically know all the ins and outs of your business, but if you take the time to put something thoughtful together that makes sense, that helps you. It's kind of, help me help you. I want to help you get something done, but if you don't provide the information that we can explain and get people comfortable with it, then it's just an easy no then. And a lot of times, people who say they've been declined for a loan, sometimes they haven't even really applied. They spoke to someone they sent a couple of things willy-nilly and they never even really put it together. I know, Paul, you know, you've seen that. People will, and then you talk to them, and then as you get into it, you realize they never really put even a package together. You know, there's a minimal expectation there that, you know, you want to put your best foot forward, give as much information as you can to explain why you're asking for what you're asking for so that someone can help you. So I would, you know, the personal credit is huge, take care of that, you know, that's not separate from a business. You know, something goes wrong, you don't get to just make a new company name. People think like, oh, well, I had this business and that failed, but this loan is for a new company, you know, and it's the same thing. We can't hide from it, you know, we're not huge corporate, you know, these are regular companies, and the people behind them is really what we care about. And it's understanding, you know, what people's plans are, what their background. We always want a story. You know, when we take deals to credit, one of the first questions, like, so what's the story? Like, they want to know, and they love more than anything. Well, this is a, you know, third generation. This person immigrated from here and here, or this person worked 3 jobs and slept in, you know, in a back office and did. They love a story. Like, we want to know what's going on. What's the character of this person? Is this just someone who, you know, is trying something for the heck of it, and they, you know, if it doesn't work out, they don't care, or is someone really vested in it? So, you know, those things are really important to us. We want to be comfortable with people, and that we've got, you know, really good, committed people. And if you feel like someone, you know, really doesn't care, you probably aren't going to be as comfortable lending. And there is some fight that has to go on with all of us in banking. You know, if I feel passionate about a deal and I want to get something done and there's pushback, I'm going to fight on that deal. And you will use that magic bullet once in a while when you need it and say, listen, I don't ask often. I believe in this company. I believe in this deal. I'm going to get that deal done. If the borrower is kind of and I don't get a positive initial feedback, we're probably not going to push it. You know, I don't, you know, you don't care that much. You know, so it's not just every deal. Look, you really, you know, you really want to think about that and talk to your accountants, your attorneys. Make sure that your financial reporting is in order. You know, the banks can only look at your tax returns when you're looking at an SBA loan. We can only use that. If it's not being reported properly, we can't do anything with it. So you need to report.
So the bank has money and they want to lend it, and
We do.
they gotta
We need
help
the whole
you.
story.
Right.
Yeah.
We need the
They
whole
have to
story.
do
We're the
some
front
work.
line. We're not the underwriters. Like, we want you to tell us everything, and we will really work with you to get it done. And we then have to sell it, so to speak, to our underwriters. The numbers aren't the only thing that they look at. They want to hear the whole story. Why, how, when, where, how long.
So we're back to that sales 101.
Yes,
Right? You have to sell them to help them sell
that's
you.
exactly it. So we're your
We'll get
advocate. You know, you have to sell us in order for us to be and go to bat for you.
Well, thank you very much. Thank you,
Thank you.
appreciate it.